XRP is collapsing. At least, that's what the chart on your screen is telling you. Since the start of 2026, XRP has lost more than 50% of its market value and nearly 70% from its July 2025 peak. Stop losses are firing. Retail investors are panicking. Across crypto forums, the conclusion is simple. This is over. On the surface, it looks like a failed trade, a broken chart, a dead asset. But while the crowd is rushing for the exit, something highly unusual is happening on the other side of the market. According to recent ETF flow data, the same 48 hours that price collapsed, institutional inflows into XRP products surged to record levels. Bitcoin is flat, Solana is bleeding, yet large pools of capital are quietly accumulating XRP. This is not normal price action. This is a divergence. So the real question isn't why is XRP crashing? The real question is, what do institutions see in XRP that the market is ignoring? Hi everyone, you're watching Global Macro and Crypto. Today, we're breaking down what I call the XRP Paradox, a market behavior that, on the surface, looks irrational, but underneath may be deeply strategic. An asset that has lost more than half of its market value since the start of the year, while, at the exact same time, some of the largest financial institutions in the world are quietly increasing exposure. Pause and think about that. If price is the ultimate signal, why are sophisticated investors stepping in while everyone else is stepping out? At first glance, this makes no sense. And when markets stop making sense, that is usually when the most important structural shifts are happening. Because markets don't move on headlines, they move on structure, on incentives, on constraints, on who is forced to sell, and who is financially engineered to buy. And once you understand that difference, the XRP price action starts to look less like chaos and more like positioning. But to see it clearly, we need to start where every crash truly begins: human psychology. In the short term, markets behave like a voting machine. Every candle is a vote cast under emotional pressure: fear, pain, urgency, regret. After a 50+% drawdown year to date, the average investor doesn't see a discounted asset. They see a shrinking net worth. They see months, sometimes years, of progress erased. And the brain does something fascinating under financial stress. It stops optimizing for profit and starts optimizing for relief. Selling becomes psychological anesthesia, not because it is rational, but because it ends the pain. This is why capitulation often happens near local bottoms, not due to lack of intelligence, but due to neurology. Loss activates the same brain regions associated with physical danger. Your body literally interprets a market crash as a survival threat. So, people sell. They promise themselves they'll buy back lower. They move to cash. They wait for certainty. But markets rarely reward the search for certainty. Now, here is where the narrative flips. Because institutional capital does not experience markets this way. Institutions don't operate emotionally. They operate structurally. A pension fund doesn't wake up anxious because XRP is down this week. A sovereign allocator doesn't panic over red candles. Their decision horizon isn't measured in days. It's measured in decades. So, they ask a completely different question. Is this network becoming more or less important to the future financial system? Notice what is absent from that question. Today's price. Institutions care about infrastructure durability, legal clarity, settlement efficiency, counterparty risk, liquidity depth, regulatory survivability. Price volatility is uncomfortable, but irrelevance is fatal. So when price collapses, sophisticated capital does something counterintuitive. They zoom out dramatically. Let me give you an analogy. Imagine a major global city suddenly hit by a historic storm. Power grids fail, airports shut down, communication flickers. From street level, the city feels broken. Residents panic, businesses close, traffic disappears, fear becomes contagious. In that environment, people don't negotiate well. They sell prime real estate for fractions of its value, simply to escape uncertainty. But strategic capital sees something entirely different. The storm is temporary. The geography is permanent. The ports still exist. The rail lines remain. Fiber cables are still buried underground. In fact, once the lights return, the city may become even more valuable. So, while locals flee, capital moves in. Quietly, patiently, without emotion. Right now, XRP resembles that darkened city. The price collapse is the blackout. But the deeper question is this: has the financial infrastructure disappeared, or is it still standing? To answer that, we need to zoom out again. Because this story is bigger than XRP. It is macro. We are no longer living in the era of free money. Global liquidity is tightening. Real rates remain elevated. Capital, once abundant, is now selective. And liquidity is the oxygen of speculation. When oxygen is plentiful, everything floats. When oxygen is scarce, only assets with real utility keep breathing. This transition matters more than most investors realize, because every tightening cycle forces the same market evolution. Narratives fade, cash flows matter. Utility wins attention. This is why so many crypto projects struggle in restrictive monetary environments. They are priced on future possibility. But expensive capital demands present function. And this is precisely where XRP is attempting to reposition itself. Not as a story, not as a cultural asset, but as financial plumbing. At the same moment price is collapsing, Ripple appears to be crossing a threshold very few crypto projects ever reach: regulatory viability. And even more importantly, pathways toward banking licensure. Slow down here, because this is not a headline detail. This is a regime change. A banking license doesn't magically transform Ripple into a bank, but it does something arguably more powerful. It allows the company to operate inside the regulated financial architecture rather than orbiting outside it. That distinction changes institutional behavior overnight. Suddenly, compliance departments can engage. Risk committees can model exposure. Legal teams can stop saying absolutely not and start saying under certain conditions. This is how adoption actually begins, not with hype, with permission. And once an asset becomes permissioned, capital that was previously prohibited can enter, which brings us to settlement. Global cross-border payments remain shockingly inefficient. Transfers can take days, intermediaries stack fees, liquidity gets trapped across jurisdictions. For multinational banks, this is not a minor inconvenience. It is a structural cost center. So, when a network claims it can move value faster, cheaper, and with fewer balance sheet frictions, institutions pay attention. Not because it is exciting, but because it is economically rational. Banks do not chase innovation for its own sake. They adopt tools that compress cost and reduce operational drag. If, and this is critical, XRP can materially improve settlement mechanics at scale, attention turns into allocation. Now, let's connect this to flows. When institutional inflows rise during a price collapse, the signal is unusually clean. It tells you that sell pressure is being absorbed, mechanically, consistently, often algorithmically. Retail sells because they must protect near-term capital. Institutions buy because their mandates allow them to extend time horizons. In macro finance, this process has a name: ownership transfer. From weak hands to strong hands. Not smarter hands, stronger balance sheets, longer patience, greater tolerance for volatility. Pause for a second. If you've just joined, here's the core framework. Price is falling because emotion dominates the marginal seller. Flows are rising because structure attracts the marginal buyer. That divergence is the signal, and signals like this rarely appear without consequence. Now compare XRP with much of the crypto landscape. Take Solana, fast, innovative, developer-driven. It behaves like consumer technology. And consumer technology is profoundly liquidity sensitive. When capital flows freely, adoption accelerates. When liquidity contracts, growth multiples compress. XRP is attempting something different. It is not competing for attention. It is competing for integration. not a race car, a freight railroad. Race cars attract spectators. Railroads move economies. One generates excitement. The other generates dependency. And when trillions need to cross borders, excitement becomes irrelevant. Legality matters. Reliability matters. Predictability matters. But no macro thesis is complete without confronting risk. So let's talk about it. Deeper banking integration introduces a philosophical tension. The closer crypto moves toward traditional finance, the further it may drift from its censorship-resistant roots. Centralization risk rises. Control surfaces expand. Gatekeepers reappear. There is also displacement risk. Banks could develop proprietary rails. Consortium chains could bypass public tokens entirely. If XRP fails to demonstrate measurable cost advantages, the utility thesis weakens. And if utility weakens, valuation follows. Remember, markets don't price hope indefinitely. They price evidence. But markets also don't wait for certainty. They price probability. And right now, institutional behavior suggests the probability of integration is rising. From their perspective, volatility is tolerable. Regulatory hostility is not. Illiquidity is unacceptable. If XRP is systematically reducing those tail risks, then a crash stops looking like a warning and starts looking like access, a liquidity event, a window that does not stay open forever. So, what is the deeper takeaway here? Do not confuse price action with structural progress. Financial history is full of assets that looked broken, precisely when their foundations were being reinforced. Amazon fell over 90% during the dot-com collapse, while quietly building the infrastructure that would dominate global commerce. Surface panic, subsurface construction. The XRP divergence carries a similar texture, fear above, framework below. So where does this leave us? Two realistic paths emerge. Either this is strategic institutional accumulation ahead of deeper financial integration, or regulatory gravity and centralization. Pressures eventually suffocate the thesis. But regardless of outcome, one rule endures: follow the flows, not the candles. The chart looks terrifying, the structure looks intentional. And when those two signals conflict, macro investors pay very close attention, because the biggest opportunities rarely feel comfortable in real time. And that is exactly why this moment matters. In the next video, we're going to dissect the Clarity Act and the quiet currency Cold War unfolding in plain sight that almost no one truly understands. Thanks for watching Global Macro and Crypto. I will see you in the next one. If this added clarity to your perspective, hit like and subscribe. Now, let me ask you this. Is Ripple becoming a regulated bank a genius move to dominate global finance? Or does it mean the project has sold its soul to the very system crypto was meant to replace? Leave your view in the comments below. This content is for educational purposes only and does not constitute financial or investment advice. Always do your own research.